Hey, it's me, and if you're here, you already know you don't want the sugar-coated version of markets. You want what's actually happening while it's still moving. So stay with me, because silver just ripped through levels nobody expected this fast. The dollar is slipping under your feet, and trade tension headlines just turned into real policy threats. This isn't slow news. This is now news. And if you understand what's driving it, you can start seeing these moves before your feed catches up. Here's the urgent part. Silver has surged into that $100 to $120 range, and you're seeing it at the same time the US dollar weakens and tariff chaos is back on the menu. You might be thinking, is this just hype? Is this just another metal spike? Is this something you should ignore? Or is this the kind of environment where you actually get ahead by understanding the mechanics instead of reacting late? Before I explain what caused this, let me teach you something that most people never learn about how markets behave when uncertainty hits. You've probably noticed that when the world feels shaky, you feel an instinct to hold something solid. That's not emotional weakness, that's pattern recognition. Markets do the same thing. When currencies wobble, when trade policy gets messy, when headlines feel unpredictable, money starts walking toward things it trusts more. Think of it like this. If you're standing on ground that suddenly feels soft, you look for a rock. Silver becomes that rock for a lot of capital. You see it in flows, you see it in volume, you see it in the way momentum builds once price breaks key levels. And once you understand that behavior, you start spotting these setups again and again in your own charts and your own analysis. Now, here's a question for you. When was the last time you saw a major asset class make this kind of move without some deeper structural shift happening underneath? Probably never, right? That's because markets telegraph their intentions through behavior before most headlines catch on. If this is making sense so far, drop a comment and let me know what you're watching right now, because I want to know where your attention is. So, what does that tell us? It tells us that you're not just watching a price spike, you're watching capital make decisions based on changing confidence levels across the entire system. And that's the skill you need to develop. Not reacting to the move after it happens, but recognizing the conditions that create the move before it accelerates. Now let me show you what's actually happening under the surface, because this is where it gets interesting. The primary driver right now is safe haven demand. You've got a weaker dollar, you've got geopolitical noise, and you've got renewed tariff threats between the US and South Korea. When Washington signals higher duties on Korean imports, markets don't just hear policy, they hear friction. Friction slows trade, friction clouds earnings, friction increases risk. So when that trigger hits, here's the cascade. The dollar softens because confidence in smooth global flows drops. As the dollar weakens, metals priced in dollars look more attractive to international buyers. That draws more capital in. Then technical traders see the breakout above resistance levels they've been watching for months, and they pile in with momentum strategies. Then long-term allocators notice the macro shift, and they start adjusting portfolios with bigger position sizes. Each layer reinforces the next, and suddenly you're not watching a small rally. You're watching a narrative build in real time. Here's what's wild about this. The move in silver isn't happening in isolation. It's being confirmed by currency behavior and by policy risk at the same time. That convergence is what gives this move credibility. When you see multiple independent signals pointing the same direction, that's when you pay attention. One signal can be noise. Two signals can be coincidence. Three signals start to look like a pattern. But here's the part that should make you pay attention. The secondary confirmation layer is coming from something most retail traders completely ignore. You're seeing institutional flows shift. Not rumor, not speculation. Actual documented capital movement into precious metals funds and away from dollar-denominated assets. That's not day traders chasing headlines. That's smart money repositioning based on their risk models telling them something changed. And when institutional money moves, it doesn't move fast, but it moves heavy. Think of it like turning a cargo ship. It takes time to change direction, but once it's turning, you can't stop it quickly. That slow, heavy capital is what creates sustained moves, not the quick in-and-out trades that disappear in a day. So, when you see retail excitement and institutional repositioning happening at the same time, you're watching two different types of fuel hit the same fire. Now let me show you what very few people are talking about. The convergence proof is in the correlation breakdown. Normally, you'd expect certain assets to move together in predictable ways. Stocks up, dollar up, that kind of thing. But right now, you're seeing those correlations break. The dollar's weakening while some equity sectors stay firm, and metals are surging while traditional safe havens like treasuries aren't showing the same conviction. That tells you the market is rewriting its playbook in real time based on conditions it hasn't seen in this exact combination before. Why does that matter to you? Because when correlations break, opportunity opens up. That's when you get asymmetric moves, where one asset explodes while others stay quiet. And if you're only watching the headline narrative without understanding the correlation and structure underneath, you miss the actual signal. You end up reacting instead of positioning. Let me take you back and show you when this pattern showed up before, because history doesn't repeat, but it absolutely rhymes. In 2008, you saw currencies wobble as the credit crisis unfolded. Trust in institutions shook. The dollar initially strengthened as people fled to safety. But then, as the crisis deepened and the Fed started aggressive intervention, the dollar weakened and precious metals started attracting serious attention. Silver went from the mid-teens to nearly $50 over the next few years. Same behavioral pattern. Uncertainty, currency instability, and then capital flowing toward tangible assets. Zoom forward to 2020. Pandemic uncertainty hit, aggressive policy shifts followed with unprecedented money printing, and you got a weaker dollar environment as stimulus flooded the system. Silver exploded from around $15 to nearly $30 in less than a year as people search for something stable outside the traditional currency system. Every time this combination appears, trade tension plus currency weakness plus global uncertainty, you see similar behavior, not identical outcomes, but similar rhythm. Here's one more. Go back to the early 2000s when the US started running massive trade deficits and the dollar began a multi-year decline. What happened? Silver went from under $5 to over $20 by 2011. Same pattern. Confidence cracks in the currency system. Policy creates friction in trade, and alternative stores of value shine. The larger story is this. When confidence in the system cracks, capital looks for alternatives. That's not conspiracy theory. That's observable market behavior repeated across decades. And the lesson you should extract is that you're not trying to predict the future with certainty. You're learning to see the weather pattern so you're not surprised when the storm forms. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this move be overextended in the short term? Absolutely. Could silver pull back sharply after such a fast surge? Of course it could. Markets don't move in straight lines. And if anyone tells you they do, you shouldn't trust them. Could this be a head fake where big players are positioning for a reversal? Maybe. I'm not going to sit here and pretend I have perfect visibility into every institutional strategy. Here's the thing, though. It doesn't actually matter whether some hedge fund is playing both sides or whether someone's trying to manipulate short-term sentiment. The mechanics are what matter. The dollar is weakening. That's measurable. Trade tensions are escalating. That's documented. Safe haven demand is increasing. That's visible in flows. Focus on what you can verify and what you can control, which is your understanding of the drivers and your own risk management. The thing you should focus on isn't perfection, it's process. Are the drivers still there? Are the signals still aligned? Is the fundamental picture supporting the price action? Those are the questions that keep you grounded when everyone else is either panicking or celebrating too early. There are probably 3 types of people watching this right now, and I want to speak to each of you directly. Maybe you're the cautious observer who's been burned before. You watched silver spike in the past, you chased it late, and you got crushed when it reversed. You're thinking you don't want to repeat that mistake. That's valid. You should absolutely respect your risk tolerance and your past experience. But here's what I'd tell you. Don't let old pain create new blindness. You can study this pattern without acting on it. You can understand the mechanics without putting capital at risk. Your job right now isn't to trade. It's to learn deeply so that when the next setup comes, and it will, you recognize it earlier. Or maybe you're already positioned. You bought silver weeks ago or months ago, and now you're sitting on gains you didn't expect this fast. You're wondering, should I hold? Should I add? Should I trim and take profits? Here's the honest answer. Nobody, including me, can tell you exactly what you should do with your position, because I don't know your time frame, your risk tolerance, or your overall portfolio. But here's what understanding the drivers does for you. It helps you make calmer decisions. If the fundamental reasons you bought are still intact, volatility shouldn't scare you out. If those reasons are weakening, then taking some profit might make sense. The framework matters more than the specific action. And maybe you're new. You're just trying to understand what any of this means. You hear silver, tariffs, dollar weakness, and it all sounds like a foreign language. If that's you, your job isn't to act fast. Your job is to learn deeply. Don't let urgency push you into decisions you don't understand. Take the time to study how these pieces connect. Watch how markets respond to policy news. Track how currencies and commodities interact. Build the foundation now, so you're not guessing later. The universal principle for all of you is the same. Understand the mechanism before you touch the trade. That applies whether you're experienced or brand new, whether you're already in or watching from the sidelines. Knowledge comes before action, always. So, here's what I want you to answer in the comments. Are you watching this move as a trader looking for entries? Or are you watching it as a longer-term investor trying to understand the macro shift? Because the answer changes how you should interpret what's happening. Now, let me tell you where I stand, because you deserve to know my perspective. I'm not blindly bullish, and I'm not dismissive either. I'm watching. First, I'm watching the dollar for confirmation. If the dollar continues weakening and breaks below key support levels, that would validate the safe haven thesis and suggest this move in silver has more room to run. Second, I'm watching how policymakers actually act on these tariff threats, not just what they say in press conferences. Talk is cheap. Implementation is what changes market structure. Third, I'm monitoring whether silver holds strength on pullbacks, because that tells you if conviction remains or if this was just a momentum spike that fades fast. Based on my analysis, this move was mechanical, not random. The fundamental picture hasn't weakened. You've still got a dollar under pressure from policy uncertainty. You've still got trade tensions creating friction in global flows. You've still got institutional capital looking for alternatives to traditional currencies. Those fundamentals don't disappear in a week if history rhymes and silver consolidates above the $100 level instead of collapsing back down. The move that follows could be significant. I'm not making a price prediction because that's not useful. What's useful is understanding that sustained moves above major psychological levels tend to attract more capital, not less, especially when the fundamental drivers remain intact. Now, I'm not a financial advisor. This is not financial advice. Everything I'm sharing is my analysis and my perspective. You need to do your own research, verify every claim, and make your own decisions based on your own situation. If you made it this far, you're serious about understanding markets, not just reacting to them. That mentality will serve you well. Share this with someone who needs to understand what's actually driving this move. Subscribe if you want more real-time analysis without the hype. And stay ahead by learning to see these patterns before they become headlines. This is the kind of environment where preparation beats reaction every single time. Stay sharp out there. Think critically, verify your data, and always make your own decisions.